100K per month cash flow system. Now, many people try to save a lump sum, and anytime you come across the working class, people are trying to save, say 10 million, 15 million, 20 million, so that by the time they retire, they've got a lump sum that they can always withdraw from. What if I told you that trying to think in a lump sum is not the correct way of thinking? You rather start thinking about a system that can give you 100K per month, and so you create a system that will give you cash flow of 100K per month, because retirement is not about a big number in your bank account. Retirement is about cash flow. So how do you generate 100K per month in cash flow when you are nearing your retirement age or time? And at this, we are talking about the age of 60 years. So in this video, I'm going to break down how you can create a system that will give you 100K per month, so that you are liquid. And I want to explain why having cash flow is important than having a lump sum. So I want to say that cash flow, just having a cash flow, is much greater than having a lump sum. And I want to break it further and tell you that having a cash flow of 100K per month is much greater than having a lump sum of, say, 10 million. And I'm going to show you through calculations why cash flow is much important than having a lump sum. And so we shall build 5 assets. I'm looking at my notes. So we are going to build 5 assets, and it's a 5-asset cash flow system that will enable you to generate 100K per month by the time that you are 60. And we are going to do the actual rates. We are going to use the rates that we have in the market right now, so that we are building our 100K per month once you hit age 60. So section 1, I want us first to talk about the mindset shift. Section 1 is mindset shift. Section 1, yes, mindset shift. Because there's a way our minds have been trained that you need a lump sum. So, and under this, I want us to do, this is how we think. Anytime you're talking about salary is always equals to active income. And over time and time again, I've talked about this, that the difference between active income and passive income. So if you're talking about 10 million lump sum, so you have to constantly be working for you to raise that particular amount. But so that's why we are saying salary is equals to active income. When you stop working, when you stop working to earn a salary, then this active income also stops. So that's why we need to work on creating systems that will enable us generate 100K per month, more or less passively. Because when you stop working, the income stops coming. And so your goal before 60 is not how much can I save, but your goal becomes how much monthly cash flow can my assets generate. So in this video, my main objective is going to generate, we are going to build assets that generate 100K per month. And I want us to work, as I've said, this will be mathematical. So we're going to do a lot of math, but basic math that you will be able to understand and follow. So what have we said so far? We have said that we are going to change our mindset shift from having an active income from a salary to having passive income, to building assets initially, assets that will enable us to raise the 100K per month. So let's set the ground. So we are saying, so if you need 100K per month, that equates to, so we need 100K, we multiply that by 12, so that we know how much money we need in a year. So this will give us 1.2 million per annum or per year. So if we can create assets that will give us 1.2 million per year, that will equal to 100K per month, because this is 100K times 12. So 100K times 12 is 100,000. 100 Gs multiplied by 12, this gives us 1.2 million. So when we have assets that give us 1.2 million per year, that will equate to 100K per month. So that is the math that we are going to do. And let us quickly go to asset number one. So we have 5 assets, but inside the 5 assets, I also have got a bonus that I'll share with us. So asset number one, I want us to talk about money market funds, MMF. And I know I've talked about this in so many of my videos, but just hear me again. Now, why are we using money market funds? Because of liquidity aspect. Liquidity. And I've discussed this, that liquidity is when you are retiring or when you are nearing to retire, you need an asset that anytime you have an emergency, you can run to and get that particular amount of money. So that's why we have the money market fund, because of the liquidity aspect. We need liquid money. When you are sick, you need somewhere that you can get your money. When you have an emergency, you need somewhere that you can get your money. That is why we are building an asset known as money market fund for liquidity purposes. And for each asset, I'll be giving us examples. So for example, money market funds, we have got CIC, we have got Britam, we have got Sanlam. So CIC is known as CIC Asset Management, Britam Asset Managers, and then Sanlam Investment East Africa. Now, money market funds are quick. The yield for money market funds is between 9% to 11%, roughly. They have got others that are slightly lower, the others that are slightly higher, but this one is the average. Now, for us to work well, I want us to use a conservative figure, which is 10%, so that we are able to work our math well. So we are going to work with 10%. And there's a formula that I want to give you. So I've said 10%. The formula that I'm going to give you under money market funds, basically under all the funds that we shall look at. So I'll say that in money market funds, we need to raise 20K. That is the sum that I forgot to tell you. So every asset, we have a particular amount. So in money market funds, we need to raise 20K. So we work backwards. There's a formula that says annual income is equals to principal times rate. What do I mean? For example, now annual income, if we need 20K per month from money market funds, then we need 20 times 12 to give us 240,000. So in a money market fund, we need a bucket of 240,000. If we have 240,000 and it gives us 20,000 per month, then at the end of the month, we shall be getting 20K per month. So we need this one per annum, 240K per annum. Now we reverse the formula because the rate is 10%. Money market rate is 10%. 10%. This is the same as 10 over 100. We get 0.1. So I want us to reverse, and I want to clear this because my whiteboard is small before I buy a bigger one. So we just have to bear with us. So we have 240 and we have 10%. So work with me here. Now I'm going to take the 240,000 per year, then I'm going to divide that with the 10%. 10% is the same as 10 over 100, which is just 0.1. So if I divide this by this, then I will need, we are revising the formula, we'll need 2.4 million. So if we have a bucket of 2.4 million in a money market fund, and money market fund pays us at 10%, which is 10 over 100, then it means that this 2.4 million will give us 240,000 per year. When we divide this by 12, which we come back to our 20K per month. I hope you have seen the math. I've done very simple math. I've said that we need 20K from money market fund. So I multiply 20 by 12 to get 240,000. Now, because it's giving us 10%, I reverse the formula, the working, to get to 2.4 million. So 2.4 million as a bucket will be able to give me 240,000, which will be giving me 240 over 12 will be giving me 20,000 per month. And so that is the sum that we shall be using all across. So I've said that money market fund, we need 2.4 million. Let's move to now. What's the purpose of this money? This money is, its purpose is liquidity, and I've discussed that. Liquidity, basically liquidity, emergencies, stability, something to keep you stable during emergencies. Then low volatility cash flow, low volatility cash flow. So that is what we have under money market fund. Let us go to asset number 2. So now that we understand the formula, the subsequent one should be much easier. So I want to wrap this, and so that we go to asset number 2. And asset number two, I'm going to talk about dividend stocks. We know about this. We've talked about this. And why am I doing this? Because I want what I refer to as equity cash. Equity cash. Work with me. Now, what are some of the best? I said for each I'll be giving examples. What are some of the best performing dividend stocks? I've got Safaricom, KCB Group, and then Equity Group. For example, we have Safaricom, KCB Group, then Equity Holdings, Equity Group or Equity Holdings. These are some of the well-known, well-performing dividend stock. Now, again, the average yield for this is between 6% to 8%, 6 to 8%, 6 to 10. 6 to 10, if you check, the yield is around 6 to 10%. But for purposes of working out, I'm going to use a figure in between, so I'm going to use 8% for this yield. Now, I've said that I've put an allocation that for dividends, I need them to give me 25K per month. So I need 25,000 per month from dividend stocks. So again, we are going to work backwards the way we did. Now, 25,000 per month, a year will imply that we have 25,000 times 12. This will give us, I think, 300,000 per year. 300,000 per year. So we need a bucket. We need a bucket that will give us 300K per year from dividend stocks, where the yield is 8%. So again, we are going to work backwards the way we did. So allow me to clear my whiteboard. And we are looking for an interactive whiteboard because we are expanding. So I want a bigger whiteboard, interactive one. So if you know where we can get one, or if you can give us one, we shall really appreciate that. So we need 300K, as you have said. So I'm going to divide this one by 8%. That is 8 now over 100, which is 0.08, to get the bigger bucket that we need to get this money from. So this will give us 3.75 million. So we are saying if we put 3.75 million in dividend stocks, this money will be able to give us 300,000 per year, which will be able to give us 25,000 per month. So you see our math now, it has become simple. And remember, it's giving us this one, but we still have our capital preserved there. This money we still have it. No, our money 3.75 is still preserved. Let's go to asset number 3. Asset number 3. We have treasury bills and bonds. Treasury bills and bonds. Why am I saving here? I'm saving here because of stability. This is a layer that is supposed to give us stability over time. Stability. And I need 30K from these bills and bonds. I need them to give me 30K per month. So that we work our math backward as we have been doing. So 30K per month, I need 30K per month. It means that per year, I need 30K times 12. This will give me 360,000 per year. So Treasury bills and bonds will give me 360,000 per year. You know that they pay that those bills mature in 91 days, 182 days, and 364 days, while bonds is between 2 years and 30 years. But they always pay after a period of 6 months. So we divide our working so that we break it down into a monthly sum. So now, averagely, Treasury bills and bonds have been paying between 11% to 14%. They've been paying between 11% and 14%. So I'm going to work with an average of 12% so that we are able to work out a near average value. So I'm going to take our 360,000 again and divide by 0.12. I've divided this one over 100 to give me 0.12. I'm dividing 360,000 divided by 0.12 to get the bucket that I want to invest in a treasury bills or bonds so that it will be giving me 360,000 per year. So, and this will give me 3 million. If I divide this one, I get 3 million, 3M. It means, again, I'm explaining that if we invest 3 million in treasury bills and bonds, which will give us an average of 12% annually per annum, we'll be able to be getting 360,000 per year, which is 30K per month. That's bucket number 3. Bucket number 3. Let's go to bucket number 4. I hope you are following. Bucket number 4. Bucket number 4. Bucket number 4. Rates. Rates. We've talked about rates. This is owning a property or shares in a property without dealing with tenants. And I'll give you examples and how much we are targeting. Just before I give you examples, from rates, I'm targeting 15K per month. I want rates to be giving me 15K per month. So we shall do our usual math and work backwards. So examples are Econ Holdings, for example. Econ, I think I'll put an R. Econ Holdings, yes. Econ Holdings. Another good example is Stanley Fahari. Stanley Fahari. I rate. So these are the examples that you can look at. We've done videos on how to invest in rates, but you can always check them out. So as I've said, the target is 15K per month. So we want to get per year, how much will it be? So 15K, I take 15K, I multiply this one by 12, so it'll give me 180,000 per annum year. So I need rates, these ones, to be giving me 180K per month. Now, averagely, rates have been averaging between 8% to 10%. I'm going to wrap that so that we have a clean working space. Between 8% to 10%. So I'm going to wrap this and retain our rates, 15%. So we have said that rates will give us 180,000 because I've multiplied this 15 by 12. So 15K times 12 giving us 180,000. So we need 180K per annum. So we work out backwards. And I've said that the returns for rates are between 8% to 10%. But so we want to work with 9%. So if we divide our 180,000 divided by 9%, which is 9 over 100, will be 180,000 divided by 0.09. This will give us 2 million. 2 million. Which means, again, if we invest a bucket, a lump sum of 2 million in a rate, it will be able to give us 180,000 per year, and this equals to 15,000 per month at a rate of 9%. I hope that is very, very clear. Now, I've got one more and then a bonus, and then we shall be done with this video. So the last one is either rental or SACCO income. So asset number 5. Asset number 5, we have either rentals or SACCOs. They are together because the returns are roughly the same. And examples of, if you're talking about SACCOs, examples are things like Stima SACCO, then Mwalimu National SACCO. That's two that are well known. Rentals and SACCOs, they give an average of around 12% returns. This value can be higher or this value can be lower, but we are going with an average of 12% per per year. And so I've said I want rentals and SACCOs to be giving me 10K per month. So we work our math again. 10K per month is 10K times 12, which will give us 120K per annum. So I need rentals and SACCOs to be giving me 120K per annum. So we do our math magic just to see what amount of money we will need. So we divide remember we have said that the rate is 12%. So if we take our 120,000 and divide by 0.12, how have I got a 0.12? This is a percentage, so I've taken this one over 100 to give, I've divided that, so I'll need 1 million. So if I raise 1 million and put it in either a SACCO or a rental, find a rental that will give you 10K per annum, then cumulatively it will be at 12%, it will be giving me 120 per year, which equates to 10,000. If I divide this one by 12, I get 10K per month. So those are the four. Those are the five. Now I've got a bonus. And after this bonus, I'll do the final math, and then we call it a lesson. Now, bonus asset number six. Bonus. So I call this either a business or intellectual property. Intellectual is double L. Intellectual property. What does this mean? Of course, I'll give examples, but now asset 1 to 5, everything that we have covered, all of them, they require capital. You need capital to invest in REITs, you need capital to invest in bills, you need capital, all of them require capital. But this one doesn't require any capital. Why? Because it's your brain here. You've been working for 10 years, 30 years, so you have proven that there's value, that there's a market in what you're doing. So this is one layer that you're going to add. And what can this be? This can be something like consulting. In whatever field that you are in, you can be a consultant. Whether it's finance, whether it's HR, whether it's education, or whether it's tax, whether it's IT, you can be a consultant. So you can do consulting. Let me just write here so that you don't accuse me. Consulting. You can do courses. You can develop courses. And when we talk about consulting and courses, I help people who are about to retire to set up consulting and courses, digital templates. You can as well write a books. And as you are talking about books, I wrote one. I just want to share that with you so that you know what you're talking about. This one, after the last bell. This is a teacher's blueprint to monitor your skills, redesign your career, and thrive beyond the classroom. I wrote this book. This book goes for 1,500. Every month, I strive to sell 10, only 10 of them, 10 books. So these 10 books, when I sell them at 1,500 per book, they're able to give me 15K per month, this book. This intellectual property, this is a book. And so if you are a teacher and you're watching this and you would like to monetize your skills, you would like to set up asset 6, get in touch with me, and then we shall have this book delivered countrywide. It's known as After the Last Bell. You see, I'm the author right there. We continue. So this can be, you can also be a board member. A board member, because you are knowledgeable about a particular field, so you can be a board member. Now, I've purposed that for business, we need to raise 10K. So this bonus for business, it needs to give us 10K per month, 10K per month. Business, if you've done a business, then you know that raising 10K per month from a business is not very hard, but it's not very, very hard if you've mastered your business. So what does this look like? 10K per month from business might look like 5 clients, each of them paying you 2K. Then you have your 10K. Or 2 clients, each of them paying you 5K. You see? Or just one client, you just have one client who is paying you 10K. Using your skills. You can do this under coaching, you can do this under consulting, you can do this under course creation, you can do this under books, the ones I've talked about. So, and this will be able to, this is a bonus. So if you're able to raise 10K per month, this will give you times 12, this will be around 120K per year. And so this just adds to the bonus of what you can do. So as I finish, I'll do a summary. But as I finish, I want you to understand the following. That assets gives you cash flow. Skills give you intellectual cash flow. And the beautiful thing is that intellectual assets don't depend on interest rates. You can set your price. When this book, as I'm saying, this book, tomorrow I can decide that I want to sell it at 2,000. When I see demand, after 1 week I can say now this book is 3,000. I decide the price, I set the price because it's my intellectual property and no one controls the value apart from me. I know its value, so I control its value. So that's why we are saying that intellectual assets don't depend on interest rates and they don't depend on market rates. So I hope you get that. So now we are saying that, just to sum up the total system that we've talked about, we've said the following, that money market funds will give me 20K per month. Stocks will give me 25K per month. Bonds will give me 30K per month. REITs will be able to give me 15K per month. SACCOs or rentals will be able to give me 10K per month. Now I've added business or consulting, which is also giving me 10K per month. And you see, this one goes beyond 100. This gives you 20, this gives you 40, 70, 95, 105, or around 110. So you see, it's very possible to attain 100K per month in cash flow. Now this money will be coming constantly cash flow. Unlike when you have a lump sum of 10 million, which is slowly losing value because of things like inflation, which is at 6 or 7%. So this will give you 100K. But now, what is the trade-off? So the trade-off that you have to build, we've talked about it. We've said that 2.4, you need 2.4 million. So 2.4 million in money market funds. You need 3.75 in stocks, 3 million in bonds, 2 million, I think, in SACCOs, and then 1 million in something like that. So you don't need 30 million. So in total, this money came to around 12.15 million. Because we have got 2.4, we have got 3.75, we have got 3 million, then you have 2 million, then you have got 1 million. So you want to put this money somewhere. The total lump sum is this one, but this money will be giving you 100K on monthly basis. So this is a realization that for you to retire well and to retire early, you don't need 30 million, you don't need 50 million. You need roughly 12 to 15 million that is structured into appropriate cash flow. And that will be achievable between 25 to 30 working years. So if you start working in your, I'm not going into much, so if you start working at maybe 25 or 30, then you have 30 to 35 working years. So 30 to 35 working years. So if you discipline yourself, to build this asset, then you'll be able to attain this, which will comfortably be giving you 100K per month. I've seen most people, we train employees around this across the country, and most people chase lump sum. People say that I just need 10 million, I need 15 million. People chase lump sum, but smart investors chase cash flow and systems like these ones that will be able to generate income for you. So, how can I increase my monthly asset income every year? You change the perspective on how you think. So, don't ask how much do I need to save? Do I need 10 million or do I need 50 million? No. Ask, how much does my portfolio pay me monthly? So that's how you build a portfolio that will be paying you monthly. And that marks the end of that video. If you like it and if you find it helpful, please share it and ask questions. Ask questions if you need one-on-one coaching or one-on-one assistance in how to structure your portfolio. Get in touch with us and we will help you to build a portfolio or build a system that will be able to be paying you on a monthly basis. It doesn't matter whether you are 20, 25, or 30 or 40. The bigger challenge that people think, those who are in 20 and 30 and watching this video, you think that you have time. No, my friend, you don't have time. So you rather start now. So because retirement, you don't retire towards something. You don't retire to an amount. You retire to a cash flow. That's the end of this video. It has been longer, but it's necessary. So I'll see you.